Hello, everyone. Happy Friday, and welcome to the final bar. We'll talk about the market really pushing to the downside. We talk about this week being digestion week. Today, the afternoon session, particularly after 3 o'clock Eastern, really pushing to the downside. What does that mean for the overall trend? We'll talk about the market trend model, which we review every Friday, giving a negative signal in the short term model for the first time in a number of months. We'll review that and many, many more charts. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market activity using the power of stock charts, using data visualization, technical analysis, behavioral finance, investor psychology, decision making, all of those things to focus on the message that the markets provide by focusing on key indicators of trend and momentum. I've always reminded people I think you have three goals as an investor. Number one, identify trends. Number two, follow those trends. Number three, anticipate when those trends may be exhausted. And the answer to the first two questions, at least for essentially year to date, has been the identifying the trend. It's been positive overwhelmingly for the average stock. In terms of following those trends, it continues to push higher, remaining above an upward sloping 50-day moving average. We get to that third piece, which is starting to anticipate when the trend may be reversing. Days like today, which I would classify as a broad distribution day. This is the day when most stocks are down. This is a day when you have a lot more losers than winners. And at the end of this week, where you had a shortened holiday week, but plenty of distribution, certainly makes me want to feel a little more comfortable about risk assessment and potential downside. Now, we have great guests on the show, had a number of fantastic guests this week. Ryan Dietrich from LPL Financial as well. I want to talk next week with Louis Yanis on Tuesday the 14th. Louis is the founder of WealthNet Investments in Colorado. On Wednesday the 15th, Alessio Retigliano, he's from Wyckoff Analytics, focus on cryptocurrencies. He'll give us his take on that active market. Next Thursday, the 16th, Frank Capilleri, the technical analyst at Instinet in New York. And then the week after, on Tuesday, the 21st, Tony Zhang, the chief options strategist at Options Play. Also, coming up very soon on September 18th, coming up end of next week, is the TSAA annual conference. The TSAA is the Technical Securities Analysts Association. It's an organization based in San Francisco. We are super proud to support the organization and sponsor their event coming up on September 18th. Great speakers like Chris Kimball, Ari Wald from Oppenheimer, Arusha Paris from IBD, Craig Johnson from Piper Sandler. Many of those that we've had on the show or contributed content to stock charts at times really, really know the markets, know their stuff, and know charts. So go to tsaasf.org to sign up for that event. Also, want to announce an upcoming webcast from me with market misbehavior coming up next Tuesday, the 14th at 1 o'clock Eastern. The event is called How to Avoid Confirmation Bias. I have found that to be the sneakiest and most prevalent bias for institutional investors and individual investors and financial advisors. We'll talk about what confirmation bias is, the tools you can surround yourself with to try to minimize its impact, and how to look at the markets based on the evidence, not based on your preconceived biases. Go to marketmisbehavior.com/confirmation bias to sign up for that free event. Let's continue on with our Wrap the Week segment. I love Fridays because it's a great way to try to make sense of things, take a step back from the short-term movements, focus on the big picture. And so our poll question actually this week is really geared off of that long-term perspective. We asked you, in your opinion, what's the probability of the S&P 500 closing above 5,000 on September 31st, 2001? And just to orient ourselves, the S&P currently around 4465 or so. We'll call it 4460. So by far the third a third of you responded below 30%. That was the most. However, there was no clear majority here. Next after that, and not far behind, was a 50 to 70% probability. And then the next two, 30 to 50%, and then above 70%. So really, it was all over the place, but I would say skewed to the downside. The most popular answer was a below 30% probability. The reason why I asked the question that way is because I would encourage you to think about the investment landscape as a series of probabilities. I posted a video on my YouTube channel earlier this week. It's called Market Misbehavior. We talked about Tesla and four potential scenarios for Tesla over the next 6 to 8 weeks. The reason why we do it that way is because there's one most likely scenario that you can probably come up with, but then there are alternate scenarios that could play out. So is there a chance the S&P can go above 5,000 by the end of the year? Absolutely. I think it's a non-zero probability. Is there a chance the S&P goes below 3,700? There is a possibility. I would say unlikely, but it's possible. And so thinking about those probabilities of all of those different scenarios, what your portfolio might do, what a particular position might do, can make sure that you're not caught off guard. And that's the essence of that question. And I appreciate many of you suggesting unlikely. And I would agree. I would not put it in there. I'd probably put it in the 30, 50% range if I was voting there. Let's continue on with our wrap the week segment. So what we like to do is start with a chart of the major asset classes and how they've performed over the last 5 trading days. Usually we had a shortened holiday week, so we're starting it last Friday on September 3rd, skipping the holiday and then going at the 4 trading days we've seen since. What have these major asset classes done? Well, at the close here, the S&P finished the week down 1.7%. When we've called this a digestion week, think of the last couple of weeks as the big meal. This week was about digestion, and the challenge is this can quickly become indigestion if the market starts going down. And it's funny, we actually use the horrible phrase "puking up" returns if we continue to go much lower than this. Hopefully, it does not come to that, but that's what this beginning could look like. It's all about defining your risk, which we'll talk about when we look at a chart of the S&P 500 here in a few moments. A couple things underperformed the S&P this week. Gold was down 2.3%. In purple, we have small caps using the Russell 2000 down 2.8%. So small caps, the weakest of the bunch here. Everything else on the chart here outperformed. In pink, we have the NASDAQ 100 only down 1.3%. In orange, emerging markets only down 1.2%. I would keep your eye on that emerging markets to developed markets ratio. It's actually starting to favor emerging markets again here recently. Up here, we have in red TLT, which is the long bond ETF, up 0.2%. In brown, crude oil, up 0.3% using the USO. And then the US dollar, actually the best performer, up 0.6%. We talked about that strong dollar environment and what that means for US versus non US returns. We did not have Bitcoin on here. Added on the list, and you can see why I kind of took it off. It's an outlier to the downside, down 8.5%, moving a little bit lower again today. The big movement lower was over the weekend into Friday, where it came off pretty suddenly, and most cryptos are down in a pretty decent way. Bitcoin, Ethereum, and Litecoin and others all sort of struggling this week, but overall underperforming stocks and by a fairly good clip here. The remainder of our Wrap the Week segment will be devoted to the Mindful Investor Live chart list. You can get to this list, by the way, at any point. Go to the articles tab, go to my homepage, which is called the Mindful Investor, and you'll see a button at the top to access this live chart list. It appears here at the close, given the weakness that we had, that the short-term market trend model, we review this every Friday, the short-term model has been bullish since June. Basically, it looks at the weekly close versus the 5-week exponential moving average. Gave a sell signal today, and we actually closed below the 5-week EMA just barely here going into the close. And earlier in the day, I was sending a note to my market misbehavior premium clients, did not, sort of saying it looks like we may get there, but we'd have to really distribute going into the close, which we've now done. So it's confirmed a short-term sell signal. It's only happened a couple times so far this year. Once in June when we pulled back, and then another time in February, another time in January. Each of those times indicates at the very least the beginning of some sort of pullback. And the question is how much it materializes from there. So going into next week, we'll talk here in a moment about some of the key levels to talk about. The long-term model has remained very, very positive for over a year. That is meant to capture the long-term trend. That's going to remain positive until you get a significant pullback in the S&P 500. The weekly PPO or the weekly MACD actually turned negative in May. And this is an interesting one. It's been a little frustrating to see the medium-term model be negative as S&P goes higher and higher. The way I've sort of made sense of that is it really is picking up on the internal weakness in the market. The trends are just not as strong as they were before, and you're seeing that on a lot of names that are actually breaking to new swing lows. While the S&P made a new high last week and pulling back a little bit today, a lot of stocks are well past the pullback stage into the fairly significant correction stage. You don't have to look that far. Look at some of the consumer staples, look at energy, a bunch of different sectors that you're seeing those pullbacks that are fairly meaningful, 10, 20, even 30% or more. So that medium term signal being weak or being negative has reminded me to focus more on potential risk than potential return, and it served me overall fairly well here. The daily chart of the S&P, we spent a good amount of time here in recent days dissecting this one just because we sort of had this distribution phase so far this week, really pushing lower today. And again, let's put it into proper context. We're still about a week after, or a little over a week after new all-time highs. So the S&P is not far off significant all-time highs. What we've talked about recently, I think I'd repeat here today. There are three things I would look for that would tell me that the S&P is no longer in an up phase and beginning, at the very least, the beginning of some sort of down phase. And how significant that is, it will be the next set of things we'll probably talk about, given, if that would start to happen. But first thing is you need to make a lower high. We're still coming off of all-time highs, which means at some point we have another bounce higher, could be next week. And the question is, do we eclipse the previous highs? Every other time year to date, we've pulled back and then we've rotated and made new all-time highs. At some point that breaks, and that tells you that things are starting to be a little more concerning. Last time that really happened, I would argue back here in May, is where we undercut the April low, and that's when we started to think a little bit more about downside protection. As you know, the market didn't really, the downtrend didn't really materialize. We reverted higher soon after. The second thing would be a break below the 50-day moving average. This has been the line in the sand, and I've been focusing on it. Many other strategists have certainly been talking about it, and that's why, to me, it tells me that it's a fairly widely followed indicator. And while that's encouraging, because if we hit the 50-day, I would expect at the very least to bounce higher because so many people are expecting that. But what happens when it doesn't hold? That's when I think you could see a flood to the exits as we realize the 50-day is no longer the floor in the market. We see that stocks can actually go lower. We start to see gains or losses materialize on individual stock charts. That's when things can get a lot lower, a lot more quickly. The final trigger, I would say, would be a break below the most recent swing low here in August, which is around 43.60. We break all of those, or we confirm all of those three things: a lower high, a lower low, and a break of the 50-day. You will hear my voice become a lot less encouraging and optimistic, and much more, encouraging you to think defensively and think about cash versus, risk assets, and think more risk off. We're not there yet. Breadth measures overall not quite updated for today. These are going to come off a little bit, but overall, I think at the best, I mean, at the least, they're neutral. If not positive. I think the S&P cumulative advanced decline line still in a trend of higher highs and higher lows. The NYSE and the mid cap AD lines have both recently made new all time highs or new swing highs. We've not seen that in the small cap breadth. So if we would sell off from here, the small cap AD line will become the new indicator that you're probably going to want to follow, because it's the only one that has not confirmed this uptrend. It's been in the last couple of months rotating more to the downside. This breadth reading, I think, is an important one to pay attention to. This is the percent of stocks above their 200-day moving average. We've talked about this earlier in the week, and I think paying attention to this level where we're at. We're now currently at the lowest level that we've been year to date. The last time we were this low was back in November. So, we're making new swing lows. And again, not updated for today. This is going to come off a little bit more, most likely, given the weakness we saw today. But keep that in mind. That still means 3 out of 4 S&P stocks are remaining above their 200-day moving average, but we are not confirming these recent highs. So July, August, new highs, and even in early September, this has been trending lower, which tells you plenty of stocks are not just breaking down through their 50-day, they're breaking down through the longer term smoothing mechanism. We need to take a quick break. We'll be back with a special tribute to the September 11th attacks. Be back in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close for our show. A couple quick announcements before we get to our next segment. First off, we love to hear from you. Questions that come up as you're analyzing your own charts, questions on technical indicators, on particular trends, ratios, momentum indicators, whatever it is, we're here to point you in the right direction. You can get your questions to us via email. That's the best way. The Final Bar at StockCharts.com. We're also on Twitter at FinalBarSCTV. We're on YouTube. Just go to our YouTube channel called Stock Charts. Put a comment below the video that you're watching. We'll do another mailbag segment on today's show. We'll do another one next week on Tuesday, and we'd love to answer one of your questions there. Also, go to stockchartstv.com, use your email address, set up a free account, start watching all of our great content, our fantastic guests, special events like the pitch and our year in review, and also some of our wonderfully hosted shows. Go to stockchartstv.com or search on your mobile device on any of the app stores for StockCharts TV on demand. So tomorrow, September 11th, 2021 is the 20-year anniversary of September 11th, 2001. It's a challenging day to remember. For I know for me and many others that were in New York, had friends and colleagues that were lost. So something that I know many struggle with. So we thought about how best to give a tribute to this special day, and we wanted to feature a conversation we had with Jay Woods. Jay was the executive floor governor at the New York Stock Exchange. We asked him when we were on the floor a couple of years ago for his best day on the floor. And his answer was how the floor reopened after 9/11. Here's my conversation with Jay Woods.
The best day of my career was 9/17/01, which was September 17th, 2001. That was the first day we opened after the attacks. Now, that morning on 9/11, the attacks happened before we opened. We never opened that day.
Right.
So, the people, we were 2 blocks away from the action. And it was a day we all have our own stories of how we got out of the building, what we saw, who we were with, how did we get home. And there was 4 days the market was closed. The longest stretch since, I think, World War II that this stock market was closed. We don't like to close more than a day. 2 days in a row is a no-no. So coming back into this building, seeing the people, knowing the market was going to be down, I think it was down 6.6% that day.
Yeah.
As a market maker, you're going to be under stress, you're going to be under duress, you're going to lose money. But
Right.
my firm, which was Goldman Sachs at the time, we had a big meeting with our leadership here on the floor, and no one was worried about a P&L. It was all about the people, making a strong market, being there for our listed companies, being there for the people that all had their own stories that day. But more than anything, being the face of capitalism and the face of the country. All eyes were on that opening bell that day. We had politicians from both sides of the aisle come ring that bell, the first responders. There was a giant American flag draped across these pillars behind us for forever. So being able to be a part of that, part of American history, financial history at least, and with this great group of people, was probably the most amazing day. And yes, we lost money that day, and no one will remembers the P&L, or should. I think we all do, because that's how we're trained. But that was the one day.
So it was a encouraging discussion, remembering and celebrating the recovery soon after September 11th, 2001. Thanks so much, Jay Woods, for that gift. Let's continue on with the Final Bar mailbag. As a reminder, shoot us an email, thefinalbar@stockcharts.com, with any questions that come up as you're analyzing your own charts. Let's get to the questions. First off, on the mystery chart, do you just use a minus sign to differentiate the two symbols rather than a colon to create a ratio? Yeah, in our show yesterday, on Thursday's show, we did a segment called Level Up, where we focused on how to compare two different securities. If you missed it, that is exactly the way to do it. You can literally create a spread of any two things by doing the one ticker minus the other. So the way I use this more often, the reason why I use this most often, is to do the difference between two interest rates, the 10-year yield minus the 2-year yield. You could also do this for like a corporate spread, corporate bonds versus government bonds, or anything where you're taking two things where a ratio doesn't make sense. It's more the difference. Just do ticker number one minus ticker number two. You can do a similar sort of thing to look at a ratio, as you implied in your question. Ticker number one, the colon, the two dots, and then ticker number two. And it's a super easy way to do that. You can do that with any two symbols. We're working on some really cool additional ways to combine different tickers, but for now, that's an easy way to do so. Next question, is the RSI 14 period the best or most suited for weekly and monthly charts? Also, would it be wise to discount the monthly until the month has completed? It's a really, really thoughtful question, and yeah, let me hit it. So when you're looking at weekly data, I often use the RSI 14 period regardless of what time frame I'm looking at. However, on weekly charts, I actually often will use the 9-period RSI. And I did that because when I was looking at a bunch of charts years ago, looking at a bunch of stocks, the 14 period was just a little too long term. It wasn't capturing the trends early enough. It wasn't recognizing the overbought and oversold conditions that I was trying to understand on the weekly chart. So I made it a 9-period RSI, and it worked pretty well. So what I've seen for most people is the 14 period, which was really Wells Wilder, he created it, he tested it and found the 14-day or the 14 period to be the most effective. Now we're running on a lot of different asset classes that I would argue he really wasn't when he designed the indicator. So I've tended to use the 9 period on the weekly, and on the monthly, I've tended to use the 9 period as well. I would encourage you to experiment with different settings. That's sort of the next level of indicators. What I would not suggest you do is start changing the periods all the time. I think that's where you start curve fitting. If you try to find an optimized period that looks really good for a particular chart at a particular moment, you're not really applying that discipline consistently. You're more curve fitting to the data of that particular chart. The last part of your question, should you discount the monthly until the month has completed? Absolutely. One of my mentors, Jeff Weiss, who's the technical analyst at Clearview Trading Advisors, was at Jessup and Lamont, one of the oldest New York City brokerages for years and years. He loved looking at weekly and monthly charts, but he always waited for the weekly close. The weekly chart does not tell you anything until Friday, 4 p.m. Eastern. That's when the new weekly close is updated. That's when you can look at the weekly charts with the newer data. So we show the current bar that's being updated, but you really want to put very little weight on it until the close is locked in. That's why the monthly closes can be really helpful to wait for, because it gets rid of all that noise during the month and focuses on what happened from month end to the next month end. Next question. Do you know what the symbol input is for the AD line for the QQQ? I actually have no idea what it is, but I actually do know what it is. That's not true, but I'll show you how it's easy to find it if you don't. And breadth indicators, to be honest, there's no consistent way for any platform, StockCharts or any other, to refer to breadth data. Every platform, and I've used many of them over the years, do they very differently, and it's pretty much up to each chart provider, market data provider, to come up with their own methodology. It's a super nightmare, but I'll tell you how we try to make it easy. It's all based on keywords. So if I type NASDAQ advance, you will find a bunch of tickers, and these are the ones I would use. $ NAAD is the advancers minus decliners. $ NAUD is the advancers versus decliners volume. So it's looking at volume on up stocks versus down stocks. Now, those are both giving you the actual reading every day. So if I bring one of those up, it's going to be a super choppy chart because every day it's going to be up or down. So you can use those tickers on a cumulative chart, make it a cumulative style chart, or we have a cumulative index called exclamation point AD line NAS, which is going to give you the NASDAQ advanced decline line. Now, those are all based on the NASDAQ composite, by the way, not the NASDAQ 100. You want to search on individual indexes, individual tickers to find the particular breadth indicators. That's the best way to find breadth at this point. On my list as chief market strategist here, to come up with some much better ways, we're thinking about a breadth homepage, which will have all of these stored and illustrated very easily for you. Some more to come on that, but we will get to it at some point for sure. But that's the way I would use a keyword search to find that data. Next question on the uranium ETF, ticker URA. Is this a confirmed head and shoulders top which failed? That's a really good question. I've not looked at this yet, so let's take a look. I'm guessing, based on your question, I remember you did send a chart with this because I looked at it earlier. You're looking at this phase right here. So I think you were saying if you assume June is the head, and then you kind of have this shoulder over here in May, shoulder in July. You actually have a number of shoulders, but here, if you take the shoulder in May and the shoulder in June, so head and shoulders pattern has a high, a top surrounded by two lower tops. So it's sort of like the head and the two shoulders. The neckline is the line basically between those two appears to depend on what you call the shoulders. Your neckline could be very different, but no matter what you picked, we broke down through it to hit the 200-day, and then we reverted back higher, and we've broken up there. So depending on how you'd actually call this a head and shoulders, it absolutely could be. So, and the reason why I'm being a little squirrely with this answer is, if you want to be a purist, I would say that's the head, the left shoulder, the right shoulder, which means that's your neckline, which means actually it played out beautifully because that's the height of the pattern. You take the height, you subtract that from the breakdown. It actually worked magnificently and picked out your low just as you would. But if you're thinking like, this is more the shoulder, and then you're putting it here and you're saying this is a shoulder, and maybe that's what you're talking about. I think that's what you pointed out in your question. That's shoulder number one. That's shoulder number two. Those are your swing lows. In which case, yeah, it's very much a failed head and shoulders. That was a breakdown that didn't follow through. We reverted back to the upside, and have now broken above there. The question is always, how do you determine that it's a failed head and shoulders top? And I usually use a trend line using the head and the right shoulder, whichever one that you would describe. And a break above that trend line at the very least tells you that things are starting to change, and it's probably no longer a head and shoulders pattern, is what I would suggest that that means to you. So the reason why I'm giving you a couple different answers, it really depends on what you call the head, and what the head is pretty clear which shoulders you would identify. That's why patterns like this are actually relatively subjective. There's no hard and fast rule. Moving averages are a moving average, and as long as you calculate moving averages the same way, it's pretty straightforward. Head and shoulders patterns are a little more subjective, and that's why it's a little different. Probably the last question, giving the timing here. I have been struggling with the definition of hourly or 60-minute charts. The US stock market is open every day for 6.5 hours. Where does the extra 30 minutes go? Should I use 65-minute charts to make it even? That's a really good question. So, yeah, what most chart providers do, which we do too, is basically allocate things based on 60 minutes, and then you have this little 30-minute segment that's left over. So you take the first 30 minutes and you make that its own bar, its own candle, and then it's an even hour every minute, every hour after that. So 11 o'clock a.m., 12 o'clock, 1 o'clock, etc. has their own. So that's our methodology, is to basically consider the first 30 minutes of trading as its own candle with an equal width. There's no great way to do that, because otherwise what you do is you have a partial candle that's not really filled. So what do people do about it? You can do some really weird exotic thing, like do a 65-minute chart. I've seen people try to do that on our ACP platform elsewhere. You can try that if you like. But not my favorite option. You can also do 30-minute charts, which means you have an equal number. Then you have 13 little bars or candles equally distributed to look at the trading day. And so that's really your choice. Make some exotic sort of weird amount. The problem I have with looking at something like a 65 or 73-minute, or whatever you want to do based on the instrument you're trading, is you're coming up with these weird times. And, I think people tend to think of the first 30 minutes as a thing. You think of 3 o'clock to 4 o'clock as a time that has meaning, because market participants are doing different things at those times. If you have some weird time frame, you're really not capturing that hourly movement dynamic in stocks or in ETF. So that is what I would suggest, is use the 60-minute chart, and just understand that on something like stocks that are actually trading on an uneven time, you just have to allocate that 30 minutes. We tend to do the first 30 minutes, which makes sense because that's where a lot of retail investors are trading those items. We need to wrap the show, folks, and go to the 3 and 3, three charts in 3 minutes. Here we go. Chart number one is my market trend model. We review this every Friday on the show as part of our wrap the week segment. I just wanted to point out that the short term model, I didn't even have a chance to change the label, but it did in fact turn negative. It's only been negative a couple times, 3 times to be exact, year to date. Each one of those have been during some of the significant pullbacks, significant being 3 to 5%, if not a little more. But overall, we are starting to look a lot like some of those previous periods, and I think that's something to pay attention to for sure going into next week. I would think about that daily S&P chart or NASDAQ chart or whatever you're looking at as your big picture benchmark, and focus on the line in the sand you want to pay attention to. Chart number two is the VIX. I think it was last week, Bob Lang from Explosive Options. We talked about the VIX together. We talked about the VIX getting above 20 and how that can indicate we're in a pullback mode. Now, his comment was, if you get the VIX back above there, you get into these previous ranges. That's sort of the buy on the dips argument, and I would be looking for a buyable dip. I think that totally makes sense, and I get the argument because that has worked so many times. I would think of this the same way as I would think of the 50-day moving average. I don't mind taking a shot at that being yet another buyable dip. But as one of my mentors, Greg Morris, pointed out, all new highs are bullish except the last one. That last new high that ends up being the final one was the worst time possible to want to buy, because that's the end of the move. So as always, I would be thinking about the risk reward on something like that. If you're buying pullbacks, the risk is it's not a pullback; it's the beginning of something deeper. So make sure you have your risk assessment clearly defined. Finally, my guest yesterday, when we were talking about offense versus defense, Todd Sohn from Strategas showed a chart. We didn't really look at the chart, but we talked about consumer discretionary versus consumer staples. The ratio that he answered with, when I asked him, what chart would you look at to determine when to get a little more defensive? And it was this line, the bottom half of this chart, which is the equal weighted consumer discretionary versus the equal weighted consumer staples. Looking at how that trend has been, it's really been sideways since March. That's when it last made a significant new high. From there, it's really tapered off, and it's been more of a sideways trend. We're right where we were back in March, mid-March right now, 6+ months later. This ratio breaking down would indicate that stocks like Amazon and Home Depot and Tesla and others are no longer really driving higher as much as the staples are really weighing things down, some of the defensive areas of the market. So looking for that market, that ratio to turn lower would be a move more to the defensive side of the ledger, cause for concern. that's a wrap for this week. Thank you so much for watching. For everyone here at StockCharts.com, I'm Dave Keller. Be well, stay safe. We'll see you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.